Assalamualaikum and hello, Mr. Sharul. My name is Nur Aifanabiha binti Anwar. Today we will present an analysis of DG Berhad and Maxis Berhad, two leading telecommunications companies in Malaysia. For our next slide is Meet the Group. Our team consists of Nur Fatah Hazlami, Muhammad Zulkifli Amri, Nur Aifanabiha, me, Nur Amira, Nur Batisha. For our next slide is our introduction. This presentation will highlight their financial performance over the past 3 years, focusing on liquidity, profitability, and asset management, along with recommendation for improvement. For organizational context, first is executive summary. DG emphasizes digital innovation in sustainability, while Maxis stands out with strong network coverage and integrated services. For industry overview, Malaysia's telecommunications industry is competitive, driven by demand for mobile data, digital services, and 5G technology. For key features is products. Both offer mobile plans, internet, and enterprise solutions. Maxis also provides cloud computing services. For customer base, DG targets individuals and small businesses focusing on sustainability. Maxis caters to a broader audience, including government clients. And last one is geographic reach. Both companies operate nationwide and are expanding into Southeast.
So we go through for the first data analysis, which is from liquidity ratio. First, current ratio. From 2019 to 2021, both Maxis and DG faced liquidity challenges, which the ratio was certainly below 1. Maxis improved from 0.53 in 2019 to 0.63 in 2020, but dropped to 0.48 in 2021. While DG went from 0.67 to 0.61 and then 0.49. This figure highlights ongoing struggle to meet short-term obligation was led by the pandemic impact. Second, asset test ratio. From 2019 to 2021, Maxis and DG reported quick ratio below 1, reflecting liquidity challenges. DG led in 2019 0.64 versus Maxis 0.53, but Maxis improved to 0.63 in 2020, surpassing DG's 0.55. By 2021, both declined, with Maxis at 0.48 and DG at 0.545. This trend highlights persistent liquidity pressure exacerbated by the pandemic. Third, days in receivable. From 2019 to 2021, DG consistently outperformed Maxis in receivable management, reflecting faster payment collection. DG's collection period were 60, 57 and 70 days compared to Maxis 72, 86 and 95 days. DG efficiency advantage underscore its focus on quicker. Fifth, days in inventory. From 2019 to 2021, Maxis outperformed DG in inventory management, holding inventory for just 1 day each year, while DG's holding period averaged 24 days in 2019, 25 days in 2020, and 30 days in 2021. Maxis faster turnover improved illiquidity, while DG's longer holding period suggests slower inventory movement and more resources tied up in unsold stock. And the sixth, inventory turnover between 2019 and 2021. Maxis consistently outperformed DG in inventory, indicating superior efficiency. In 2019, Maxis turned inventory 1,161 times compared to DG's 15.85 times, although Maxis turnover declined to 394.4 in 2020, it still far exceeded DG's 15.04 times by 2021. Maxis rebounded to 1,049 times, while DG's turnover dropped to 11.1 times, highlighting Maxis' stronger ability to convert inventory into sales and DG inventory management challenge.
We go through to the next data analysis, which is operating profitability, operating return on assets. From 2019 to 2021, DG consistently outperformed Maxis in operating profit related to assets, highlighting superior efficiency. DG achieved 77.27% in 2019, 75.60% in 2020, 80.81% in 2021, far exceeding Maxi's 9.08%, 8.44%, and 7.86%. This underscores DG's strong asset management compared to Maxi's declining efficiency. Operating profit margin. From 2019, DG consistently outperformed Maxis in operating profit margins, reflecting better cost efficiency. DG's margin rose from 23.91% in 2019 to 30.05% in 2021, significantly higher than Maxis improvement from 19.15% to 21.86%. This highlights DG's superior profitability. Total assets turnover. From 2019 to 2021, DG consistently outperformed Maxis in total asset ratio, reflecting superior asset utilization. DG's ratio rose from 0.77 in 2019 to 0.81 in 2021, while Maxis declined from 0.43 to 0.41. This highlights DG's stronger ability to generate sales from its asset investment. Account receivable turnover. From 2019 to 2021, DG consistently outperformed Maxis in managing account receivables. DG's turnover ratios of 5.16, 9.33, and 6.03 exceeds Maxis 3.90, 4.33, and 509, respectively, highlighting DG's superior efficiency in receivable collection and cash flow management. Turnover. From 2019 to 2021, Maxis consistently outperformed DG in inventory management, with much higher turnover ratios. Maxis achieved 678.67 in 2019, 617.33 in 2020, and 352.4 in 2021, far exceeding DG's 20.91, 11.21, and 13. This underscores Maxis' superior efficiency in converting inventory into sales. Fixed assets turnover. From 2019 to 2021, DG consistently surpassed Maxis in fixed asset turnover, reflecting superior efficiency. DG maintained ratios of 1.00, 0.99, and 1.00, while Maxis lagged at 0.50 and 0.47 in subsequent years. This highlights DG's stronger ability to leverage fixed asset for sales generation.
So for financing decision, we have debt ratio. A debt ratio shows the proportion of a company's assets that are financed by debt. A higher debt ratio indicates that a larger portion of a company's assets is financed by debt, which can be riskier as the company has more obligations to meet. In 2019, DG has a debt ratio of 0.9190. Meanwhile, Maxis has a lower ratio, which is 0.6864. In 2020, DG has a debt ratio of 0.9260. Meanwhile, Maxis has a lower debt ratio, which is 0.6786. In 2021, DG has a debt ratio of 0.9193. Meanwhile, Maxis has a lower debt ratio that is 0.7004. Maxis shows a lower debt ratio for 3 consecutive years, which Maxis appears to be in a more stable financial position with lower financial obligations compared to DG, as it uses more of its own equity to finance its assets. Next, we have times interest earned. Times interest earned measures a company's ability to meet its interest payments on outstanding debt and as an indicator of a firm's financial health. In 2019, DG has a ratio of 8.20 times, which is higher than Maxis, that is 4.34 times. In 2020, DG has a ratio of 7.63 times, which is also higher than Maxis, that is 3.79 times. Lastly, in 2021, DG has a ratio of 6.17 times, which is also higher than Maxis, that is 3.73 times. DG shows a higher times interest earned for 3 consecutive years, indicating DG is more capable of meeting its interest obligations, suggesting lower financial risk than Maxis. Next, we're moving to return on equity. We have operating return on assets. Operating return on assets shows how efficiently a company uses its asset to generate operating income.
In 2019, DG has a ratio of 217.12%, which is higher than Maxis, that is 21.11%. In 2020, DG has a ratio of 155.61%, which is higher than Maxis, that is 53.83%. In 2021, DG has a higher ratio, that is 151%, than Maxis, that is 51.48%. DG has a higher operating return on assets ratio, shows that DG is effectively using its assets to generate operating profits, reflecting strong operational efficiency, which is better than Maxis. So next we have shareholder value. Shareholder value includes price per earning ratio, price per book ratio, and EVA. For this three ratio, we cannot calculate for both DG and Maxis. This is because the required data to calculate price per earning ratio, price per book ratio, and EVA were unavailable and insufficiently detailed. This could also be due to changes in reporting practices or the absence of consistent data across these years for 2019, 2020, and 2021.
Projection and recommendation. For revenue growth, Maxis is projected to grow at 2.4% annually, while DG is likely lower at 2.3%. For earning growth, Maxis show a strong annual growth of 14.3%, but DG surpassed it but with an impressive 60.4%. Next, for the earning per share, which is EPS, over time Maxis expect a 14.9% annual growth in EPS, whereas DG project an even higher growth rate of 18.5%. For return on equity, Maxis boosts a robust 26.4%, indicating high profitability, while DG comes in at 40.2%. For stock price target, Maxis stock price target range between 3 ringgit 33 cents and 4 ringgit 69 cents. Meanwhile, DG has a slightly wider range of 3 ringgit 6 cents to 5 ringgit 26 cents. Lastly, for market position, Maxis holds a strong brand with steady return and is focused on 5G expansion, for DG being the largest telco post-merger and is actively scaling up its operation. Next, for investment recommendation, Maxis Berhad ideal for stability-focused investors seeking reliable dividends and long-term security. Offers steady revenue growth, 2.4%, strong earning growth at 0.3%, and high ROE 26.4%. Known for its premium brand, customer loyalty, and 5G investment. For DG Berhad, it best for growth-focused investor because they have promises high earning growth for 60.4%, strong EPS growth for 18.5%, and benefit for merger synergies and market dominance. While short-term integration risk exists, it offers excellent long-term growth potential. For the supporting research and justification, Maxis Berhad maintains a strong market position through investment in premium service and infrastructure. Research highly the long-term benefit of its premium brand and customer loyalty. For DG Berhad, shows stronger liquidity and profitability, driven by efficient asset use and cost management, alike with research emphasizing operational efficiency and creating shareholder value. Last but not least, the conclusion. The financial performance and projection for DG Berhad and Maxis Berhad are supported by detailed analysis and industry insight. These findings align with market trends, making the investment recommendation credible and well-founded. Last, thank you for taking the time to view and engage with this study case. Your interest and attention are truly appreciated.